Welcome back to the channel, everyone. Today I'm going to give you an update on Alibaba for those of you who haven't already analysed their recent earnings. I will be breaking them down for you and giving you my opinion on why Alibaba still is a very strong buy for me and why it is now the largest holding in my portfolio. We will reference the valuation that we did previously towards the end just to make sure that our assumptions match up to the actuals and just recap on what my fair value or buy price for Baba would be today. So let's jump straight into the earnings report and break down the numbers. We can see here very strong revenue growth, which we were expecting. 37% total, and the largest part of the business, the e-commerce business, actually growing at a 38% rate, which is fantastic. Alibaba Cloud, another exciting part of the business, managed to grow 50% year over year and more importantly became profitable on an adjusted EBITDA basis for the first time, driven mainly by growth in revenue from existing customers, which is good for that type of business because revenue from existing customers is always more profitable as there isn't that acquisition cost, which is the reason why Alibaba Cloud hasn't been profitable yet, but it's growing at a quick rate because it's onboarding so many new customers. But this quarter was driven by revenue from existing customers, which is what we'll want to see as it starts to grow and scale. This will be neglected as well. This is an important number. They've managed to actually grow their monthly active users by 21 million and their annual active customers by 22 million with just this quarter, which tells you there's a long runway for growth still as they're adopting millions of new users at a rapid pace and not just monetizing the existing customer base. And they're growing out that customer base. And for such a large company, it is really, really impressive in my opinion. Profitability and cash flow, we will get to those in more detail, but a very big number, as you can see, 14.7 billion of free cash flow into the business this quarter. And to put that into perspective, that's around a 2% free cash flow yield on the market cap for the whole business in just one quarter alone. Annualized, it's around 8.2%. However, this is always going to be one of the bigger quarters for Alibaba. They had Singles Day and stuff like that. And just because, there's a seasonal aspect to an e-commerce business. Even considering all of this, the stock actually dipped yesterday after earnings, which tells you all you need to know about the markets currently. We saw a similar thing with AMD when I looked at those earnings. They posted huge earnings growth and the stock was down the next day, unfortunately. The stock has bounced back since then today, obviously being up around 5 to 6%. And there's probably a lot more room to run, to be honest with you, so don't be too disheartened by the jump from yesterday. Okay, we see the results here in some more detail. I'll annualize out the numbers after so we can look at current valuations. But it's always important to note with Alibaba that net income and free cash flow are almost always more than EBIT or operating income and EBITDA in most cases as well. And this is because, as they highlight here, they receive a lot of investment and other income from businesses outside of the operating company, such as, Ant Financial is an example of that other investment income, which is a huge boost to the bottom line numbers and free cash flow. These are this is cash that the company is receiving. This isn't non-cash earnings that they're receiving. So it should be accounted for. And for investors like us who are interested in free cash flow, we should definitely take it into account. And we can see EBITDA and EBIT and non-GAAP net income were up around 26% and 32% respectively. Free cash flow up around 28% year over year, which is unbelievable for a company of this size, I've got to say. This is what people will neglect. They're such a big organization, and yet that usually means that the law of large numbers works against you at some point and limits high growth potential. But if we look at the diversification that this company has, and that has a relationship with the size of the market that we serve, I mean, this has the potential to be one of the biggest total addressable markets in terms of a company that we may ever see. Huge retail e-commerce business in what will soon be the largest market and economy in the world by quite some way. Never forget the Chinese economy is set to grow around 8 to 9% compounded for the next decade, which is a huge tailwind for a company that serves the economy on a wide scale basis. Also, a big business-to-business segment that is growing rapidly. They've got an international commerce business that is the largest exporter for China and will continue to be. Cloud computing business as well, which we've already covered, very high growth business and will no doubt become very profitable. We can look at AWS and Azure as an example in that. digital media company, which isn't growing as quickly, but still a high growth industry, and then some newer bets. And they're actually getting into groceries, we can see here, which carries quite a big appeal and some potential in terms of growth. And I think we all know to an extent why people are bearish on Alibaba, and not much has changed on that, on the Jack Ma situation, the Ant Financial situation, and the regulation of Chinese big tech. Nothing's changed on that, so I won't go over that too much. Nothing's changed from the last video I did when I covered Alibaba and why you should buy the dip. And what I will say is, when this blows over, and I believe it will blow over, albeit with some effect on Alibaba and Ant more importantly, but not big enough to stop the momentum and the numbers of which we're seeing now, the stock will soar, and if they continue to post 30% growth, it will do so for a long time. Each time they post earnings like this, it lifts the floor on the stock and makes it seem cheaper and cheaper. So based on the trailing 12 months currently, we call it 2020 full year, but obviously their fiscal year goes actually to March, so they're classing it as Q3. But we can see revenues now at 93 billion versus 70 billion in 2019. And the only company you really see that sort of top line growth with at this size was Amazon. I think Alibaba, has a long way to go, and you'll probably see it outgrow Amazon eventually, just because of the Chinese market. We've now got a company that produces 23 billion of cash flow annually, and that's a 3% or 3.1% free cash flow yield, and growing at a rate of 28%, which is at the moment. That means a 2025 expected free cash flow yield of 10.75%, and it will still be growing beyond that point. There's not many places in the market where you can buy such value, in my opinion. Net income, similar at around 23 billion, and that gives us a PE of 32 times currently. And then when you make that a PEG ratio, that means the PEG ratio is around 1, because the current EPS growth rate's at 32, although a forward PEG ratio may not be 1, because the actual expected growth rate going forward is somewhere near 25% for the next 5 years. But even with that, we're around 1 to 1.5, which again isn't very common in the market at the moment. We would also be buying Baba at a 2025 expected PE of 4.7 times, which is very cheap. And this is all with the current jump back up to 762 billion as a market cap, or $267 per share. If you actually loaded back up when I did late December, when the sell-off happened and I told you to buy the dip, you would have bought at almost a 4% free cash flow yield and a 26 times PE in an environment where the S&P 500 has a PE ratio of 39 times and earnings are only expected to grow at less than, say, 10% to 11% per year. Let's quickly utilise the IRR calculation and valuation I did just to see if we were still in line with the return that I assumed, and recap on the fair price for Alibaba as well. Okay, let's quickly utilise the IRR calculation and valuation, which I did previously in December, and just see if we're still in line with the return, or what the returns changed to now that the stock's jumped from $220 to $267 per share, and see if my fair price still seems accurate. So in our base case, where we just had 25% free cash flow per share growth, and then a PE, or a price to free cash flow, of 25 times. This is because free cash flow and EPS is pretty much in line for Alibaba. So the IRR has dropped down slightly, but still at 30%, a very, very good return. You'll be beating most people in the market with that sort of return if this can play out. Bearish case, which says 17.5% growth and then a PE of 22, which is quite cheap. 19% IRR still, again, very good return. And then our worst case scenario, which really, you can see, we don't have a huge amount of downside with Alibaba. 12.5% growth rate, a PE of 20 times, which is quite unlikely for a company in the industry in which Alibaba are in. And of course, if they're still growing at this point, it'll be unlikely it's as low as 20 times. That's an IRR of 11% still, which is matching the market, or matching the S&P weighted return. If we just look at our forecast again and our valuation, in which we had for Alibaba, we had 2021 revenue being at around 97 billion, which they're close to already, and they gave guidance for. So, I've no doubt they will hit that number. And then our net income and free cash flow, we're not far off of either. I think they'll be able to get to those numbers, by the end of 2020. And then we've just got 25% growth up until 2025 beyond that point. And based off of that, we have an intrinsic value, or a fair price today for Alibaba, of $310 per share. So we compare that to the current share price of $267. We see it is still very much undervalued, even though our margin of safety price here gets us down to $232 per share, which I'm not too unhappy about, because The majority of my shares were bought at the 220 drop in December, but still, this is a 15% discount rate, which is a very high discount rate. So it's factoring in quite a lot of the risk involved in Alibaba. And as you can see, still well below its fair value based off of this forecast. So there you go, just my update on Alibaba and its recent earnings. In my opinion, still a buy, although this is just my opinion. Do your own research and decide if it fits your investing criteria and your investing goals, and then make a decision on investing yourself. If you enjoyed the video, I'd appreciate if you can leave a thumbs up, really helps the channel out, and subscribe to the channel if you haven't already. Thank you for watching as well, and I will see you in the next video. Good luck with all your investments.